Today, we're digging into Coupang's third quarter earnings. Now, on the surface, it looked like a fantastic report, a solid beat. But then the stock pulled back hard. So what's going on? What did the markets see that investors didn't? That's what we're going to unpack.
All right, let's start with the headline numbers. And I mean, at first glance, everything looked great. It really painted a picture of a company that was just firing on all cylinders.
So revenue came in really strong, yearly $9.3 billion. That's a 20% jump in constant currency, which is just solid. More importantly, it comfortably beat what analysts were expecting. They were looking for around $9.1 billion, so right off the bat, that's a clear win on the top line. And it wasn't just revenue, the profit story looked just as good. Diluted earnings per share came in at 5 cents. Again, that's a beat. Wall Street was penciling in about 4 cents a share. So revenue beat, earnings beat. You think the stock would pop, right?
Well, that is not what happened. Not even close. And this really gets us to the central mystery of this quarter. If the results were so strong, why on earth did the stock sell off?
Yeah, check this out. The stock closed down 5% the next day, and that was after dropping almost 7% in after-hours trading. So what did the market see that it just did not like? Okay, to understand that reaction, we've got to peel back the onion a little bit. We have to look past those big consolidated numbers and break the company down into its two very distinct parts. This is where the real story is.
Okay, so here's the core of it. You've got Products Commerce. That's the main Korean e-commerce business. It's a profitable machine, generating over $700 million in adjusted EBITDA. It's the engine. But on the other side, you've got the developing offerings. These are the big growth bets like Coupang Eats and the huge expansion into Taiwan. Now, revenue growth here is explosive, but so are the losses. We're talking a loss of almost $300 million in this quarter alone. So you've got this highly profitable engine that is funding a very, very expensive bet on future growth.
And there were two other things that really spooked investors. First, management guided that the full-year losses for those developing offerings would be at the high end of their range. That signals that the heavy spending isn't letting up anytime soon. Second, they flagged a surprisingly high full-year tax rate of 60 to 65%. Both of these things point directly to lower net income in the near term. So how did management explain all this? Well, on the earnings call, they didn't shy away from it. They framed this whole story as one of deliberate investment. Short-term pain for what they believe is going to be a significant long-term gain. CEO Bom Kim addressed the heavy spending in Taiwan directly. He basically told investors, we've seen this movie before in Korea. We know this playbook works, and the early signs we're seeing in Taiwan are incredibly encouraging. He's trying to instill confidence that this isn't just burning cash. And the strategy for Taiwan isn't some random shot in the dark. It's a methodical repeat of their success in Korea. They're expanding product selection, they're rolling out their marketplace for third-party sellers, and, this is the most important and most expensive part, they're building their own last-mile delivery network. It's a massive upfront investment, for sure, but it's the exact strategy that created their competitive fortress in Korea. Okay, so let's put it all together. What does this mean for the next quarter and beyond? This is our forward-looking thesis. This really brings us to the core question that every investor is asking right now. Heading into the fourth quarter, what are the key catalysts that could drive the stock, and what are the risks that could hold it back? Okay, for Q4, let's look at the bull case, the catalysts. You're going to want to see strong holiday spending in the core Korea business, clear progress on key metrics in Taiwan, like merchant signups and delivery speeds, and any updates on their warehouse automation. The risks, though, are what the market is laser-focused on. Just how big are those losses in Taiwan and Eats going to be? What's the broader market's appetite for risk in the tech sector? And are those near-term tax headwinds going to continue to be a drag? So our final take on this lands on a market perform rating. Here's why. The strength of the core Korean business, that seems to be fairly priced in at this point. However, the heavy investment in these new ventures and those tax headwinds, they are likely going to cap any major upside in the near term. It's a classic tug-of-war between present profits and future potential, and for now, the two seem to be stuck in a balance. And just a final note before you bow. Just a reminder, this content is for informational purposes only and does not constitute investment advice. Thanks for tuning in.